This is Nightly Business Report with Sue Herrera and Bill Griffin.
Good evening, everyone, and welcome to this special edition of Nightly Business Report. I'm Sue Herrera. Bill Griffith is off. Tonight, we're going to take a look at the year that was, from the stock market to the economy to policy out of Washington. It was a 12-month stretch filled with events that few could have predicted. The ship be rockin'. 300- and 400-point market moves are usually eyebrow raisers. Now, not so much. Markets jumped in January, tax cuts in hand, until a nasty brew of global tensions led to mounting worries about growth and steep drops in February. Immunity? Not in high flyers like Boeing, not in healthcare, not even in tech. Market darling Apple might see a loss for the year. Even as markets climbed in January, so did tensions with North Korea, claiming its missiles can reach the United States mainland. Historic face-to-face talks with South Korea and the United States followed, calming nerves for a bit. But for how long, as North Korea complains about a constant irritant, economic sanctions? To maintain sanctions, the U.S. leans on China, even as their duel over tariffs has pinched at various times automakers and parts suppliers, farmers selling pork and soybeans, steel and aluminum production, even tech, where tariff costs now top $1 billion a month. And constant threats of more and higher tariffs are rattling investors. For now, there's a March 1st deadline to reach a new trade agreement. Closer to home, a reworked NAFTA brought an agreement with Canada and Mexico. But just look around. Debt issues hang over Italy's new government. Brexit is messier than ever in the UK. And the U.S. relationship with Saudi Arabia, murky, following the death of journalist Jamal Khashoggi. Oil prices hit a 4-year high this fall before dropping more than 30% in weeks. And the stock market's path is bumpy too. Up in September, down by November, and then up a bit and down in December. Tech investors fear government regulations to appease concerns about privacy and data safety that might crimp growth. Overall, this year's earnings are stellar, up more than 20%. But was that a one-time high induced by tax cuts? Next year's forecasts are still up, but by less than 10%. And the list goes on. Will a Democratic majority in the House change or hinder the president's agenda? If growth is slowing, will the Fed ease off on interest rate hikes? In housing, sales and construction are slowing down, while mortgage rates, topping 5% for a while, are up. Employment? Still strong, and consumers are spending. Just ask Macy's, McDonald's, and the automakers. But is this economy in 2018 as good as it gets? Some say 2018 was a turning point for the market. Volatility gripped Wall Street early in the year, and it made a triumphant return in the final few weeks. Bob Pisani takes a look at the market's highs and lows.
It was a roller coaster year with several 10% swings in the market. Here's the 6 most important stories of 2018. Number 6, the tax cuts and the market boost. Earnings grew 24% in 2018, half of it due to the tax cuts. It's the best growth since 2010, but the markets sniffed out global slowing late in the year. Stocks have come down more than 10% in the fourth quarter. Number 5, it's the return of cash. Suddenly you could get a 2% on a bank certificate of deposit. For the first time since 2008, cash in short-term treasuries outperformed a 60-40 stock bond portfolio. Cash is up 2% this year. The stock bond portfolio is down about 2%. Number 4, the Bitcoin bust. Bitcoin topped out near $20,000 in December of last year, and it's closing out the year near $3,400. What did it in is a combination of endless reports of thefts and break-ins combined with an SEC that has adamantly refused to approve a Bitcoin ETF. Number 3, the interest rate spike that never happened. Short-term interest rates rose for most of the year, but longer-term rates did not. 10-year Treasury yields are about where they were in February. Those betting that rates would rise across the board were surprised when inflation remained relatively subdued and concerns about a slowing economy kept long-term rates down. Number 2, China trade and tariffs. Everyone agrees the U.S. should stand up to China on intellectual property theft, but the markets are saying it does not like using tariffs as a way to force a change in behavior from China. And the number one story for 2018, my opinion, the return of volatility. In 2017, the S&P closed up or down 1% or more only 8 times. In 2018, the S&P closed down or up 1% on 57 occasions. 26 of those were down, 31 were up. Wow. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
The Federal Reserve and its interest rate raising campaign was the focus for investors for much of the year, and it caused a lot of anxiety. Steve Liesman has been covering the central bank for us and the economy, and he joins us tonight from Washington. Great to see you, Steve.
Good to be here, Sue.
Anxiety, I think, is one word for it, but also volatility is another word, not only in the stock market, but in the bond market, correct?
That's right. And I had hair when they had those 18 up or down 1% moves, and I lost it with the 57. I mean, you had days where you'd go in and it would be, up 300 points and you'd end down 400. So there was not only day-to-day, but intraday volatility as the market swung wildly. I think one of the big stories this year, Sue, are the two halves of it. I can't remember a year where we had such buoyant growth. We were up above 3%. Remember, we hit an historic 3.7% low unemployment rate, the lowest since 1969. We were doing 200,000 jobs a month regularly, which is fantastic because if you remember, we're only supposed to be adding 100,000 to the workforce by population growth. So really strong. And I can't remember a year where there was such good economic numbers that created and ended the year with such incredible pessimism about the next one.
Exactly. And language mattered much more this year than it has in the past. It seems as though investors were parsing those Fed statements much more than they used to.
I think that's right. And I think they're especially, Sue, parsing the words of the new Fed chairman. It's well to remember Jay Powell, who's been a governor for a lot of years, only took over as the chairmanship at the beginning of 2018. And then in October, I think he stumbled. He made a mistake. He said we are a long way from neutral. This was Jay Powell trying to talk to a lay audience, talking, not to financial markets. And markets pretty much freaked out about that when he said a long way from neutral. He had to come back about a month later with his vice chairman as well and say, no. We're just below the broad range of neutral rates. And that kind of calmed the markets down. But as happened last week, this idea that the Fed still wants to raise rates is still a matter of abiding concern and a source of volatility for the market.
We will see what the new year brings. Thanks, Steve. As
Pleasure.
always, Steve Liesman in Washington. Well, trade and tariffs, once viewed as dry topics for investors, became a focal point that triggered waves of market volatility. And this year was the year that brought trade wars, and they became a reality. Elon Mui has more.
The White House celebrating several new deals. Among the trade wins, the U.S. began negotiations with Japan and the European Union. There's a new free trade agreement with South Korea and a new deal pending with Canada and Mexico.
It's my great honor to announce that we have successfully completed negotiations on a brand new deal to terminate and replace NAFTA.
That agreement is designed to encourage car companies to pay their workers more and make more of their vehicles in North America. U.S. farmers get more access to Canada's dairy market, and pharmaceutical companies get more protections for certain kinds of new drugs. Still, the deal needs to be approved by Congress. President Trump is threatening to cancel NAFTA if they don't act fast, but Democrats are skeptical.
What isn't in it yet is enough enforcement reassurances regarding workers. There also has not been a law passed in Mexico in terms of wages and working conditions in Mexico.
Meanwhile, Wall Street is focused on trade wars, tariffs on foreign steel and aluminum, also on $250 billion worth of Chinese products, about half of what we import from them. At the G20 summit in Argentina, President Trump and Chinese President Xi Jinping agreed to work on issues like intellectual property theft and forced technology transfers. They called a truce on tariffs during those talks, and White House trade advisor Peter Navarro urged investors to be patient.
We have negotiations with the Chinese that there's much talk about. What I would urge people to do on Wall Street is rather than follow this day to day and get all excited and go up and down on rumors, is to let the process take its course.
The deadline for reaching a deal is March 1st, and investors are hoping for a New Year's resolution. For Nightly Business Report, I'm Elon Mui in Washington.
Phil Blancato joins us now to talk more about the moments that defined the economy and the markets this year. He is the CEO of Ladenburg Thalmann. Nice to have you here. Happy holidays.
And to you too.
The market was a little disappointing for you, I think you said, because you had high expectations going in. Perhaps rightfully so. The economy was firing on all cylinders. What do you think happened?
You know, the sentiment changed. You heard in your earlier set, the components changed. Chairman Powell's point about a long way from neutral, and you look at the underlying economy, and it was still very strong. But for the first time, we saw small little cracks that got everyone real nervous. Now, in my opinion, the economy is still robust. It's still really powerful. In fact, the chairman said it. And you look at the underlying unemployment market, it's really strong. And he's not saying they're backing off anytime soon. In fact, I support what he said. But in 2018, what happened towards the end here was the sentiment changed. No one wanted to be the last one in the party when the cops showed up, kind of. They wanted to be out sooner.
Also, we hadn't seen volatility like this in a long, long time. Do you anticipate that continuing in the new year, or does the market turn a new leaf?
It's funny, I'm still in the camp that I think when sentiment drives the volatility, and by the way, our volatility has kind of gone back to averages. This was normal years ago to see the VIX.
Oh, yes, absolutely.
We just got lulled into this everlasting upward grinding market. So this is kind of normal to me. And a lot of this to me is going back to averages. So for me, I still see January as an opportunity. I'm still a buyer of stocks. I still think equities are now actually cheaper than they've been in a long time. So when the underpinnings of the economy, specifically the consumer, are this strong, you got to be a buyer. So I think the volatility comes out a bit, not a lot. We were going to stay elevated for a while because of this sentiment's not going to change all that much. But the January opportunity, when the data comes out about earnings and GDP, I think is a chance to make some money back.
And what sectors do you think will benefit, given the, let's say the environment stays the same as it did in 2018? We do have valuations at much more quote-unquote normal levels. What areas do you think might outperform?
Well, considering that we are moving to a later stage, and that's only because inflation and interest rates are both going higher. Usually utilities are a place to hide out, so that's a safe haven for some folks that want to be in there. I still think that the financials and technology both offer opportunity. Why? Financials have just gotten hammered. And in a rising rate environment, usually they do well. So later in the year, I think financials could be there. Tech is sold off a bit. And healthcare in and of itself is, because of our demographic makeup, it's hard not to be in the healthcare space.
On that note, happy holidays.
Happy holidays.
Thanks very much, Phil.
Thank you.
Phil Blancato of Ladenburg Thalmann. And perhaps one of the biggest changes this year came in November with the midterm elections. Eamon Javers is at the White House tonight for us. Good to see you as always, Eamon.
Yeah, hi, Sue. Merry Christmas.
Merry Christmas to you as well. Lots of changes came with the results of the midterm elections. Some of it has to do with the tax laws. Some of it has to do with basically health care, because we're going to have a change in the House.
Yeah, absolutely. The president leading up to November was predicting there would be a red wave, despite pundits suggesting there would be a blue wave. In the end, we didn't really get a wave in either direction, but Democrats made significant pickups in the House of Representatives, and they were able to snatch control of the House of Representatives away from Republicans. That means that Nancy Pelosi will be the Speaker of the House, we expect, next year, and we expect that Paul Ryan is retiring and going home. So that's a big change, and it's going to affect this Trump presidency for the last 2 years. It's going to put Democrats in charge of committees on Capitol Hill that have subpoena power, meaning they can fire up investigations into all sorts of aspects of the way that the president has been conducting business here at 1600 Pennsylvania Avenue. That's going to make things very, very difficult for the president in terms of the investigations, let alone probably a near total impossibility of passing any legislation out of the House of Representatives that the president wants to see, Sue.
You know, one of the things that the Democrats have said that they want to do when they take over the House is take a look at some of the caps that were put on state and local deductions. What do you think the odds are that they might be successful with that?
I think they might look at that, and the question is whether there's Republican interest in going along with that and where the president ultimately comes down. You know, the president was talking before the election about this idea of a 10% tax cut that he and Republicans were going to pursue after the election. That seems like it's not going to happen. Instead, I think you're going to see Treasury and other officials here sort of on the defensive. One of the things I think you're going to expect Democrats are going to go after right away is the president's tax returns. I think the White House and the administration will defend that and try not to release those, but ultimately they may be forced to do that. And that kind of a tense atmosphere is going to make it very difficult for run-of-the-mill legislation.
Eamon Javers at the White House. Eamon, thank you so much.
You bet.
And still ahead, the year the housing market went from hot to cool. The holiday season is traditionally the slowest time of year for the housing market. But as Diana Olick tells us, the slowdown this year was particularly sharp.
At a Sunday open house in Los Angeles,
I like this.
the few buyers who came out were hoping for a holiday gift.
I read an article actually online right around Christmas. It's a good time to buy a home. There's less homes on the market and less people looking for homes.
But John Gabodian still can't find anything affordable.
We're just trying to find something newer, bigger, better without remodeling our home. And it looks like we might just end up remodeling our home.
And that is the tale unfolding across the nation. Housing was super hot at the start of this year with bidding wars the norm, but prices overheated and then mortgage rates jumped, adding insult to injury. Housing went from hot to not.
Clearly, the exuberance that made them pay really unrealistic prices at the end of last year and the first part of this year seems to be gone.
The average rate on the 30-year fixed started to rise in January, but then leveled off for much of the summer, only to jump again in September and then cross the 5% mark in November. Home prices have slowly responded, still higher than a year ago, but the gains are shrinking. In California, more sellers are cutting prices as inventory rises.
It seems the price on this house, to me, I'm not an expert, but it does seem low.
Unfortunately, home builders are not stepping up as much as hoped. Housing starts are now at the lowest level in over a year, and builders continue to put up more expensive homes, while so much of the demand is at the entry level.
They just can't get down to the lowest price points, and part of it is intentional on their part, is they don't want to go to the most outlying areas where they can maybe get to those price points, because that's just a risky place to be the next time there's a recession.
And for existing home sellers, they now have to realize the sky is no longer the limit.
In a normal market, it takes several weeks or even a month or two to sell your home. In a normal market, you get 1 or 2 offers, not 10 or 20. And in a normal market, you don't sell your home for $100,000, $200,000, or $300,000 over list price.
In other words, housing is now in a new normal. For Nightly Business Report, I'm Diana Olick in Washington.
The healthcare sector saw some changes in 2018, from mergers to treatments to policy. We're joined now by Dr. Amit Phul, who's the Vice President of Strategy and Insights at Doximity. Nice to have you here, Doctor. Welcome.
Thank you for having me, Sue. Nice to meet you.
You say one of the #1 defining moments in healthcare was the awarding of the Nobel Prize, and it had to do basically with immunotherapy. Why was that such a watershed event?
So, I mean, it's been many years in the making, but this new treatment modality actually has the capability of transforming how we treat many of the deadliest diseases that currently afflict our society. I believe we're right at the tip of the iceberg, frankly, in terms of what may come out of what is now recognized as a Nobel Prize winning a bit of research.
Does it also kind of greenlight those companies that maybe wanted to go into that particular area and they now see it perhaps as more lucrative or certainly more hopeful?
Absolutely. I think we're right at the beginning, frankly, to see how this actually plays itself out in the pharmaceutical industry. And the life sciences industry will have a lot of movement in this space moving forward. And as this kind of therapy modality begins to be proven out over time, I imagine that that activity will just increase.
I also was fascinated, and I think you mentioned this as well, big tech really made some inroads in various different ways into the healthcare sector.
Yeah, definitely. I mean, if you look at Apple, Google, and Amazon as some of the main representatives of big tech, Apple actually had an FDA approval for a device that can monitor heart rate and actually be utilized in healthcare in pretty close to real time. Google, of course, we'll touch on, has made some interesting moves with regards to artificial intelligence and being able to scan folks' retinas. And Amazon has made some interesting acquisitions, particularly with PillPack being added to the Amazon family. And much the way that Amazon Prime has changed the way a lot of us interact with shipping and products being sent to us, in the very near future, leveraging Amazon's platform and delivery network, we might have a very different relationship with prescription medication.
I think there's going to be a lot of changes. Thirdly, you list artificial intelligence as one major factor. Google comes to mind with a retinal scan, but what else were you watching this year?
So if you think about immunotherapy on the curative or treatment end, artificial intelligence, specifically some of the work that Google is doing with retinal scans, actually will make some headway in the preventive end of the spectrum. They've begun to perfect technology now that can actually augment or empower physicians to more accurately diagnose diseases like diabetic retinopathy and fairly accurately predict cardiovascular disease risk. Enhancements on this technology in the near future will make a profound impact, I think, in preventative medicine.
All right, and we're going to also watch Berkshire Hathaway, JP Morgan, and Amazon getting together. Who knows what that will bring? Dr. Amit Phul, thank you so much.
Thank you for having me.
Well, can social media be trusted with your data? That question came up time and time again this year as the social media industry came under fire from Congress and regulators pretty much around the world. Julia Boorstin has the details.
Concerns about the dangers of social media platforms exploded in March, with revelations that political data firm Cambridge Analytica accessed the private information of Facebook users, ultimately affecting 87 million users. Sheryl Sandberg admitting to Facebook's mistakes in an interview on CNBC.
We have the responsibility to build great products. We have the responsibility to treat people's data carefully. We have the responsibility to disclose to people when problems occurred.
Sandberg's apology didn't stave off congressional scrutiny. Facebook CEO Mark Zuckerberg was called to testify on Capitol Hill in April, where he said regulation is inevitable.
I'm not the type of person who thinks that all regulation is bad. So I think the internet is becoming increasingly important in people's lives, and I think we need to have a full conversation about what is the right regulation, not whether it should be or shouldn't be.
Facebook came under attack for both privacy scandals and for revelations of inauthentic, manipulative behavior on its platform, pulling down hundreds of pages tied to Russia and Iran. In September, Facebook COO Sheryl Sandberg, along with Twitter CEO Jack Dorsey, were called to testify before Congress, amid growing talk of regulation to protect user data, prevent manipulation, and monitor bias on the platform.
The era of the Wild West in social media is coming to an end. Where we go from here, though, is an open question.
Sandberg and Dorsey focused on Facebook and Twitter's investments in technology and employees to improve their platforms.
We have been investing in artificial intelligence and machine learning models to, again, recognize the patterns of behavior, because we believe this is where the greatest leverage will come from.
But Congress headed into the holidays with more concerns. After a slow drip of negative headlines about Facebook's mismanagement, 2 reports for the Senate Intelligence Committee last week show Russian attempts to sow discord on social media, both before and after the 2016 election, saying Twitter, Facebook, and Google did the bare minimum to cooperate with the Senate Intelligence Committee's investigation. For Nightly Business Report, I'm Julia Boorstin in Los Angeles.
Coming up, the corporate story that kept investors guessing for most of the year. One of the biggest corporate stories focused on Amazon and where it would set up its second headquarters. More than 200 cities bid for that project, which promised jobs and capital investment. Amazon made cuts to the list all year, and then in November, the winner, and in this case, winners, were announced. Scott Cohn filed this story.
The competition was intense.
All hands on deck.
Sometimes a little weird.
We might have to start with going to the state to see if we can get the legislature to change the name to Phoenix, Arizona.
238 cities from across the continent entered the bidding for 50,000 jobs and $5 billion in investment. The result, a tie.
This was a fierce competition. I think it's exciting for Amazon. I know it's exciting for the state of New York.
This certainly consolidates Queens as a great economic capital and consolidates New York City as a great international tech hub.
New York's Long Island City neighborhood gets half the prize, a nod to a strong tech workforce. The The other half goes to Northern Virginia, a strong workforce as well, and a strategic location wedged between Reagan National Airport and the Pentagon.
It is a performance-based incentive package that we put on the table, so the return on our investment will be very good.
And a consolation prize to Nashville, Tennessee for its strong economy. It'll get a 5,000-employee operations center.
This is the largest jobs announcement in the history of the state of Tennessee. In 5,000 jobs, it will average, I think I'm safe to say, $150,000 in salary. Said it now so they can't take it back.
Amazon gave no official explanation for the split decision, but in the end, no one city in North America could provide everything the company wanted. Most important, 50,000 skilled workers in one place. The move also allows the company, which made $177 billion in revenue last year, to make the most of government subsidies. $1.5 billion from New York State, $600 million from Virginia, and more than $100 million from Tennessee.
We're seeing more than $2 billion in subsidies being offered by Virginia and New York for an expansion the company had to make.
All the locations will have work to do to make way for Amazon, like infrastructure improvements. Meanwhile, for the 235 cities that didn't make the grade, like Boston, Chicago, Dallas, plenty of questions about what they did wrong, how they can do better, and why they got into this battle in the first place. For Nightly Business Report, I'm Scott Cohn.
Thanks for joining us for this special edition of Nightly Business Report. Merry Christmas. We'll see you tomorrow.